Well, good afternoon, ladies and gentlemen. I'm Maurice Jackson. Can everyone hear me? Yeah. All right. Well, I believe you're in the right place at the right time. How many of you know that in the next 20 years, we're forecasted to consume more copper than all of recorded history combined? Is that new information, anyone? It must be, because this room should be packed, and it's not. So that gives you a competitive advantage, and which also makes me proud to present our featured company, which is Hot Chili, which hosts the Costa Fuego, which is the 6th largest undeveloped copper deposit in the world, also one of the lowest capital intensive copper projects in the world. The company has just received a $15 million endorsement, if you will, from Osisco. They're also looking to expand with a 30,000 meter drill program. And when you look at the numbers, they're trading currently at a 0.07 market cap to NPV ratio. That means sale. Simple as can be. Here to tell us more about this compelling investment proposition is Christian Easterday.
Great. Well, thank you very much, Morris. That was a good introduction. I'm thinking that a lot of people have just sat through my presentation in the main ballroom. So rather than going through the presentation again, I think that the project on summary is a very advanced asset in the copper space, one of a handful of projects that will impact supply meaningfully before the end of the decade. The economics that the PEA have put out have demonstrated a very competitive project on cost, very competitive in terms of the amount of metal that the project puts out, and most importantly, a project that offers very extreme leverage to copper price. And so, I'd probably like to focus on some of the elements that I haven't discussed in the main presentation, and then maybe provide this as an opportunity for a little bit more interaction on questions and answers that anyone may have. But just quickly to go over the basics of the project, as Morris outlined. Costa Fuego is a copper hub that we've been developing on the Chilean coastline for over a decade. It enjoys a lot of natural advantages in terms of elevation, proximity to infrastructure, and things that have now allowed the economics to demonstrate a project worthy of putting out around 100,000 tonnes per annum of copper production. There are very few of these available outside of the control of the major, which is why it's very meaningful in terms of what's about to happen next in copper. So, put simply, when we go through everything I discussed in the main presentation, and we look at the basic investment thesis for Hot Chili, this underlying exposure to copper price is something that you would have looked for in a commodity price that is about to meet inelastic demand and inelastic supply response, rather, to a demand shift. I often draw examples back to a time in the early 2000s. What would you do if you had a time machine and you knew that China was about to go through a modern industrial revolution and construction phase almost unrivaled in history, and something that created a demand shift for raw commodities such as iron ore and cement. And we had an industry in iron ore that was dominated by the majors, dominated by the off-takers. There were benchmark pricing. Projects in the pipeline were very large. They have very large capexes. They had very long lead times to production. They had IRRs 15 to 25% range. Margins were around 20%, 25% at best. Some of the very low-cost producers, maybe 35% margins. It was a low-margin business. It was also the largest metals market in the world, and still is today. So it was probably clearly incapable of doing a 10 times increase in price. There wasn't a lot of believers that would have thought that that could have ever happened until it did. There was one guy that believed it was going to happen. His name was Andrew Forrest. He created a company called Fortescue Metals. A friend of mine that went to university was lucky enough to be his first exploration manager, and is probably one of the richest people that I know. But look, that re-rate where Andrew Forrest went to the Pilbara, picked up all of the low-grade iron ore that the majors didn't feel was economic, that was even lower margin than their iron ore, enabled him to be positioned when iron ore prices took off to create now what the 8th largest mining company in the world, and a return of 186 times your investment. Those things don't happen often, but there are a few lessons that we learnt out of that. One was that Andrew employed a really simple approach. It was get your hands on the most iron ore, be the most exposed to it, and if the iron ore price was going to move, it created extreme leverage. And that's what we're trying to emulate here in a nutshell in our strategy. We're now the largest ASX copper developer by resource scale, by potential production, across producer, developer and explorer. And that's really interesting because effectively the ASX has BHP Billiton, and now it does not have a mid-tier copper sector to expose itself to copper. And that puts Hot Chili in a very, very interesting position in what we feel are the precursor years to a re-rate in the copper price. We like to be very conservative here. We like to get your imagination moving on what leverage represents to a project like this by talking about a 50% increase in the copper price, and that may well be in the future something that people say, why didn't you talk about the leverage that a 10 times on the copper price would do? Well, the numbers might be too unrealistic for a CEO to want to talk about. So we'll talk about a 50% share price, a 50% increase in copper price. And when we look at the sensitivity on this graph on the right from minimum to maximum forecast by 27 banks on where copper price will be in 2027, it's a very interesting range. So if we were to put ourselves into the midpoint of that range and sort of move a 50% up, then you're talking about a 3.3 billion US NPV post-tax, and trading at a 0.25 multiple. That's where you can get your first 10 bagger just by a small puff of wind on the copper price with the story that we presented to you today. What we ultimately see in the project, as I've said, is not just about exposing and stopping where the project is right now, is trying to make this project better, more competitive and larger, and increase our exposure to copper. We're big believers in where copper is about to go, because it is very rare to see the world in sync trying to decarbonise and trying to achieve net zero and trying to electrify everything and embrace renewables at a speed for energy transition which has never been seen before. And when that kind of synchronous behaviour happens, you get the type of effect that we saw at the beginning of the 2000s, that we saw in China, when one of the largest countries in the world and largest markets in the world underwent a modern industrialisation phase. So those are the type of things that create step changes in demand. And then we go back to what we learnt in iron ore. We have a very short group of projects that can actually deliver that supply, and projects that take 20 years to develop. It means that the supply will not come, and that is probably the recipe for what will inevitably happen to iron ore in the coming years. I imagine 2025, 2026, we will see a pinch point in copper prices, and therefore leverage to any of these assets is going to be significant, as we've just seen in the lithium industry, where it didn't matter which stock you invested in, you got leverage towards 10 times just on the price of lithium. What we're trying to do is have the most amount of copper to provide our leverage formula to emulate, the type of growth that we saw in Pilbara Minerals for lithium or a FMG for iron ore. So there were a few things I didn't speak about in my presentation, which I'd like to talk about now, and for some reason they're not in this presentation, so we'll just discuss them. And we'll just look at where the project sits and have this as our backdrop. So this slide is really about the consolidated play of Costa Fuego on the coast, all of the permits that are put together and that low elevation advantage. But water being the number one de-risker on this project is really a key differentiator. We're one of only a couple of projects in the development space for copper that has a water permit. It took 10 years to secure. That was including securing land access on the coast, as well as our easement corridors along the way to build water pipelines. And so when you have that position and you have a situation where we are one of the only companies in Chile holding a license for water, and most importantly, we're the only company holding a water license in this region of Chile. Now, this is a very rich region for new mining projects, not least of all Costa Fuego sitting on the coast, and our partners Cap CMP and their iron ore operations to the north of us, just to the north of Vainar. But we have major projects in Tex, Nueva Union development, just higher up in the Andes, and also a lot of the Lundin projects which are stranded in the high Andes with no water permits. So this is a very rich project for new mining projects in Chile, a rich area for new mining projects in Chile, and Hot Chili is holding the license that provides probably the water solution for most of those developments. So it's something in the presentation I said that I'd discuss further. It means that, yes, Hot Chili has just started to talk about this. We've been aware of the value of this asset internally in our portfolio and what it might offer the company and its shareholders. It's certainly something that we'll be investigating over the next 6 months as a potential non-dilutive funding optionality that we may well look into. But more importantly, what you're actually looking at is a business within a business. When you don't have a competitor in this area for the next 10 to 15 years, if they were to start their permitting process now to establish a water license, or you have any other competitor coming from the north that is a water provider wanting to build an extensive water pipeline network to get down to this area, it means you have a unique situation that we potentially have a large water utility business within Hot Chili. So I think that Hot Chili at the moment is just happy to outline that having a water license is not just about being able to develop this project on time. It also offers us another layer of optionality on funding. And whenever you're an aspirational developer holding a large capital project, the concern has always got to be from the market about dilution. And so the recent Cisco transaction was, as I said in my presentation, about the company putting the value of the asset to work rather than the company's share base or the market capitalization, which is significantly undervalued. So in doing that, it meant that we were able to fund for the next 12 to 18 months without issuing a share. And so how did Andrew Forrest get such a leverage formula? Because he didn't dilute the share base of FMG to oblivion before he built those major iron ore mines in the Pilbara. And so managing our capital structure going forward is really key to locking that dilution on our shareholders and therefore preserving this leverage formula for all of our shareholders. And if we can do that, then ultimately it means that we need optionality within our project. And this is what our chairman, Nicky Adshead-Bell, has been talking about for about a year now, the optionality that Hot Chili has when it has 50,000 ounces of gold production as a credit, silver byproduct, molybdenum concentrate available, and not least of all, 40% of our offtake rights still intact for spot offtake agreements. The decision to move to a royalty agreement as a first step on using our assets was about managing dilution. It It was also about preserving our precious metals streaming ability. You see, a stream on an amount of gold production like that over a multi-decade period is worth a significant amount of money. When you combine it with offtake, when you combine it with assets such as our water and the ability to monetize parts of those assets, and you understand that specific infrastructure in this capital mix will be built by German engineering and therefore probably likely to involve export credit agency financing on debt, then you understand that the debt on a low-risk project like this with very fast payback is probably likely to be in the 60 to 65% bracket. And so when you look at the equity side and you make your assessment on how much can we be diluted, how much of that formula is eroded by the time this project transitions, well, if we can use streaming, if we can use the offtake that we've maintained, if we can use assets such as the water, my answer is actually very little. Probably less than 100 million of that billion would be able to be effectively put up against new shares if you were looking at our strategy now. But we hope it's going to be even less than that. And that's because the timing of the project, when we move into financing decision, will be in 2026. And I imagine the copper price is going to be a lot higher, and therefore our market cap. And so what you're really looking at is really the formula for a very rare event, which is an explorer that transitioned to a developer that actually has the ability to be able to build this and become the largest producer on the ASX outside of BHP Billiton. And that is what Hot Chili is offering. So thank you. Is there any questions before I go, Morris? Did you want to open?
We're in no rush because this is the last presentation today, so please, of course, don't go ahead.
Congratulations, Chris. It's an outstanding day, and on behalf of shareholders, I want to thanks for your hard work too.
Thank you.
Could you put a bit of flesh around the water agreement? What's left to go? What are the hurdles? How much risk there is? Would be exclusive?
Sure. Yeah, look, the port is a...
Yes, should we explain a little bit of flesh around the water agreement? Will it be exclusive? What milestones will go?
Sure. So the port arrangement that we are pursuing with Port of Los Lozos, we're very lucky to have a port that was built over 15 years ago and has seen very little usage. So this was always a natural advantage that we had. If we had our own port, then it's, I think, about 60-kilometre truck for our concentrate straight onto a boat and straight to the seaborne market in Asia. So a huge advantage for us on transport costs and managing that mine gate to port corridor. So what we've been doing with our discussions with Port of Los Lozos is looking at the optimal handling solution and loading solution for that port. We've already had significant discussions and advancement with them on a solution that they're able to offer right now, which is a rotainer solution. However, at the scale of concentrate production in this project, we're talking about moving around 420,000 tonnes of concentrate a year through that port. A bulk handling solution would be preferable for Hot Chili, not just on a cost basis, but also on an efficiency of loading basis. And we're talking about a port agreement, yes, that we'd be looking for exclusivity on, and first in line loading. So our own port facility and a long-term agreement is what we're looking at. And so therefore we're very careful to make sure that what agreement we put down is optimal for the entire life of the mine on this project. So we're moving forward in stages with our port partners, but we are definitely moving towards negotiating a bulk handling port solution. And that means there are engineering studies that are going on with our partner. And in addition, We are trying to decide whether this is going to be a 150,000 tonne project, which increases the scale of that concentrate loading to around 600,000 tonnes a year, not a small port operation. So we're taking our time with it, Scott, and making sure we get it right. Yes?
Would you say are the two greatest risks that you see potentially coming that right now not really baked into the situation?
I think 2 years ago I would have... so this is a question on what are the two greatest risks to the company. 2 years ago, I think political risk would have been in my top two. That might struggle to get in my top 10 at the moment, given the advances in Chile with the vote on the constitution, and then secondly with the great job that both sides of politics have done on the tax bill that's actually going through and being carried now after 4 attempts. Which I was very pleased to see BHP's Mike Henry making a comment that the Australian government should look to what the Chilean government just did on tax revision. So I'd say that politics probably isn't one of those two now. Copper price always is going to be. And on that sensitivity graph I showed, it's very easy to see that these projects will hardly be built at $3.85 a pound. Not many of them are the economics that would garner major investment. But all of them fall apart at $3 a pound. So commodity price risk has always got to be the biggest exposure we have. And then I would say that it's the unknown unknowns. It's the ESG aspect that would be my second risk. And for that, it's something that we constantly work on, but you often don't see it until it arrives. Yep.
Last year, you guys struck me as a long shot. And I'm wondering to what extent, I just didn't understand the presentation or whatever, and to what extent you guys have overperformed the de-risking project as a whole.
Yeah, so the question is in relation to us potentially last year being looked at as a long shot, which I think is, that's actually a nice comment because it probably reflects a new direction in the company we've been taking on marketing, a commitment to move to North America. We understand where these projects are financed and where the capital pool will be. The Osisko transaction is the first outcome of our dual listing into the North American market. As we drive liquidity into the North American market and we allow the market to effectively trade with higher volumes, I imagine that eventually this company will have a very similar experience to what happened with Craig Williams Equinox. And that was a significant re-rate, but it took time, and it took Equinox getting out and building relationships, and that's exactly what Hot Chili has been doing, and so we're very pleased with the Osisko transaction as one of the first outcomes. But I think ultimately, you know, it was about communicating our story, and I believe that the board changes with Dr. Stephen Quinn coming on, and particularly with Nikki Adshead-Bell, driving a new approach for the company to manage dilution for shareholders going forward, to communicate this more effectively, and to compete in our space, to stop being the big fish in the little pond in Australia and trying to compete against a market that was virtually non-existent for large copper equities. So I don't think that we've seen the true extent of what the North American dual listings will do. I think that we will see those over the coming years. So hopefully that answers some of your question.
Yes.
Thank you.
This will be the last question we have to
Okay.
Where can we find your company to buy shares?
Look, you can trade it on the ASX if you have a broker such as a Canaccord or a Sprott or any of the brokers that handle international accounts. you can buy through those. The good thing about being dual listed onto the TSXV and the ASX is that the stock is fungible. And what we've seen, particularly over the last 3 or 4 weeks, is a lot of North American buying in through the ASX. And I imagine that we'll probably see a lot of that stock being re-domiciled so it can be traded in this time zone. But you can buy the stock on the TSXV under HCH ticker also. And you can also buy and trade the stock on the OTCQX for US investors under HHLKF. I guess it's up to the individual as to whether you want to, if you have trading accounts over here and want to trade in your own time, probably more advantageous to trade into the TSXV. But we can see obviously that the volumes are a lot lower because when we dual listed into the TSXV, we had a great group of institutional shareholders, and the good news is that they've been very sticky, but the bad news is that they've been very sticky for people wanting to buy stock off of them. So it makes the liquidity situation maybe a bit difficult over here to get the amount of stock that you're trying to chase without driving the price up too much. Yep. Thank you.